talk about the causes of the Great Depression. So we're going to look first at politically what was going on just before the Depression hit, before the stock market crashed. Then we're going to look at kind of the um, business practices that was going on in industry and that, and then we're going to talk about the actual stock market and banks and kind of, and then the reaction to the stock market crashing. So lots to talk about today. So here we go. Okay, so we're gonna start with the election of 1928. So Herbert Hoover, that's this guy right here, he ran. He was a Republican against Alfred E. Smith, who was a Democrat, in 1928. So Smith was the first Catholic to actually run for president, which we're going to talk about was a pretty big deal. But the main issue of prohibition played a major role in the campaign because for many it was not popular, but many other people really supported it. So the Republicans really favored prohibition, and Smith didn't. Okay. In addition, him being Catholic is going to lead to a smear campaign against him, much like we saw with the Amy Coney Barrett uh, selection, I guess, confirmation hearings that we saw recently, that they were attacking her for her faith. It was similar with Alfred E. Smith. So the Republicans took full credit for the prosperity of the 20s, as we had Harding and Coolidge were the presidents. They were both Republicans, and so Hoover won easily in the 1928 election by a landslide. So, the long bull market. So, the stock market was established as a system for buying and selling shares of companies. So, a bull market is a long period of rising stock prices. Okay, so a bear market, which we're going to see a little bit later, excuse me, is a period of dropping stock prices. Okay, but this bull market, these prosperous times, are going to cause many Americans to invest heavily in the stock market. But as the stock market or the bull market continued to rise, many investors started to buy stocks on margin. So what you do on margin is you make a small cash down payment, so like 10%, and then so like let's say I want to buy $1,000 worth of stocks. Well, instead of giving $1,000, what I do is I give $100, and then once my stock goes up and I sell it, then I pay back what I owed, that remaining 900, with the profits I made from that stock. So this was safe as long as stock prices rise. And then if the stock began to fall, then the broker could issue a margin call. So if somebody issues a margin call, then you have to pay back the loan no matter what. Okay, you have to pay it back right then, whether you have the money or not. So you got to figure that out, which is not always easy. So in the late 1920s, new investors bid prices up without looking at companies' earnings or profits. So this is known as speculation. So this is basically very risky investment based on not a lot of information, but basically people were betting on the market climbing. Okay, and then they sold whatever stock they had in an effort to just to make a quick profit. So they would uh, invest in companies very quickly and then sell them and back and forth. Okay, so this right here, just FYI, this is shows you the risk and how to gain money. So saving in things like a money market account, savings account, that gives you slow growth, but it's very, very safe. If you invested in the stock market, just your money, then you can make pretty good profit. But if you speculate, so you do like day trading or you like trade currencies and things like that, that comes with very, very high risk. So you can lose a lot of money, but you can also gain a lot of money. So it's kind of iffy on how you want to do that. Okay, so by late 1929, a lack of new investors in the stock market is going to cause stock prices to drop and the bull market to end. So stockbrokers started to advise their customers of margin calls. And so what they ended up doing is to pay off the margin calls, they had to sell a lot more of their stocks. Like let's say I own stock already, but I decided to buy, I don't know, $1,000 worth of, I don't know, Disney, and then I hear that Disney's going to have a margin call. Well, then I sell off my other stocks that I own too. So this is going to cause the market to plummet even further. And then it all comes to a head on October 29th, 1929. You do have to know this date. It's going to be known as Black Tuesday. But this is the day, excuse me, that the stock market actually crashes. So this results in a 10 to 15 billion dollar loss in value in the stock market. So this does not actually cause the Great Depression, but it does actually undermine the economy's ability to hold out against its other weaknesses. So as long as the stock market was going up, the other weaknesses in the economy didn't matter that much. Okay. So one thing it's going to do is it's going to weaken the nation's banks. So banks are going to lose money on their investments as speculators continue to default on their loans because they can't pay back the margin that they were buying on. And then the government didn't at the time did not insure bank deposits. So like now today we have the FDIC, which we'll talk about in another set of notes, but we have like things like the FDIC. So if I put $100,000 in the bank and the bank closes, I still get to keep my money. Okay, so if a bank closed in the 1930s, you just lost your money. So what happened was, is as people thought that banks were going to start to close, they would do what are called bank runs. Okay, so they would go to the bank and they would just try to withdraw all their money, and so this causes a lot of banks to collapse and a lot of banks to lose their money. Okay, and a lot of people to lose their money because once the banks closed, then everybody else lost their money, and they only had to hold like I want to say like maybe 10% of what the people had invested in their bank, like actually in the bank. So once that all went away, all these deposits are coming out. Most people lost their money on these. Okay, so roots of the Great Depression. So, excuse me, efficient machinery led to overproduction. So Americans could not afford to buy all the goods that were produced, and the foreign investors weren't quite as wealthy as they had been in the 20s because of like the decline of the stock market. So there was an uneven distribution of wealth that's going to add to some of these problems. So in 1929, the top 5% earned 30% of the country's income. And so more than 2/3 of families earn less than $2,500 a year. Low consumption added to the economic problems. So what happened was workers' wages were going down. And well, they weren't going up fast enough, basically, to keep up with the standard of living that they were used to in the 20s. So they didn't have as much, excuse me, extra money to just buy things that were kind of frivolous, like cars or refrigerators or things like that. They didn't have to buy those things, and so those sales are going to decrease. And as those sales decrease, workers get laid off. There's less money there in the economy as workers get laid off, and so this is a general cycle of kind of spiraling downward into what is the Great Depression. So many Americans bought on the installment plan. So let's say I wanted to buy a car. What I would do is I would go to the dealership and I would say I want that car. He would make sure I can pay for it and he would check my credit and that. But what I would do is I would make a down payment. So let's say like I put down like $1,000. Let's say it's a $20,000 car. I put down $1,000. And so then I owe him $19,000. And so what I would do is every month I would have to pay off a little bit of that with interest. Okay, so paying off installment debts actually leaves little money to purchase other goods because let's say my car payment's $300 a month. That's $300 less dollars a month that I have to spend on other things. And so another thing that's really going to intensify things is the Hawley Smoot tariff. And so what it does is it basically raises more tax on imports. So a tariff is always a tax on Americans. It's on us. And the idea is if foreign goods are more expensive, then Americans are going to purchase more in the country. Well, the thing is as we are buying less of other countries, the other countries are buying less of our stuff, and so it became very high cost to buy anything that was foreign. So foreign countries raise their own tariffs, like I said, and so fewer products are being sold overseas, and so the markets are actually for selling something are now dwindling down to just their own countries. So, instead of raising interest rates to stop speculation, the Federal Reserve Board made the mistake of actually lowering the rates. Okay, so this actually encouraged banks to make really risky loans, and then so business owners thought the economy was starting to expand. Well, the problem is it wasn't. And because of that, they got into loans they couldn't pay back because they weren't going to be doing as much business as they thought they were. And so they defaulted on their loans. And so then the banks didn't have as much money. And so that led to more bank runs. Okay, that's all I got for you today. Don't forget to do your processor. Have a good day.